I'm gonna let you in on a little secret, guys. YouTube is a business. And as such, content creators have a vested interest in creating content that is sensational and almost too good to be true, so that people come to watch their video. We live in a world of instant gratification, so instead of watching a video showing you how you can save and invest over a lifetime, people would rather watch a video claiming to be able to pay down your mortgage in 5 to 7 years using some secret hack with a HELOC. But the reality is there is no secret hack. The creator simply talks himself around in a circle until you don't really understand what's going on. But even though you didn't understand what he was saying, you figured his method must work, otherwise he wouldn't have made a video about it. So you subscribe and hope to better understand the topic after watching a few more of his videos. But there is no hack. The reason the mortgage gets paid down faster is that you're now throwing very, very large sums of money towards your debt and thus paying it down faster. But because the content creator made it so overly complicated, you didn't even realize how much money you were putting towards the mortgage. I created a video exposing this scam, and in the process, I offered a $1,000 bounty to anyone who could prove me wrong. I'm still waiting. But there's another method that's been circulating the internet that isn't entirely a scam, but it is 99% hype and very little substance. So today we're going to be talking about using whole life insurance to become your own bank, sometimes referred to as the infinite banking strategy. Now, since the infinite banking strategy uses whole life insurance as a crucial part of it, it's important to first talk about what exactly whole life insurance is. Now, there's a million different types of life insurance products out there, but generally speaking, there's a couple of broad categories: term life insurance and whole life insurance. Term life insurance is typically very cheap, maybe $100 or less, depending if you're relatively young and in good health. It doesn't provide any benefits, except that when you die, your loved ones get a bunch of money. Term life insurance is typically what most people think about when they think about life insurance. Whole life insurance, on the other hand, is very expensive, like very expensive, but does come with an assortment of benefits to offset that cost. With whole life insurance, you might be paying $5,000 per year or more for your policy. With whole life insurance, it has two parts: a death benefit when you die, just like with term life insurance, but it also has a living benefit, a savings component, if you will. Now, this savings component, you can access that money whenever you want, either by withdrawing it outright or by using it as collateral to obtain a relatively low interest rate loan while you're still alive. The money in this cash benefit will continue to grow and compound, usually at a guaranteed rate of about 3 to 4% per year. And you'll also usually get a dividend payment of about 1 to 3% per year. This money inside the cash benefit is guaranteed to never lose money. So it doesn't matter if the stock market crashes or anything crazy like that. You can never, ever lose any money. It can only go up. Now, the general premise of this infinite banking concept is that you become your own banker. They advocate that you try to rapidly build up this savings component, this cash value component of your whole life insurance policy. And then if you ever need to buy something, maybe like a new car, you use the savings aspect of your life insurance policy to obtain a loan from the insurance company at relatively cheap interest rates by using your cash benefit as collateral on that loan, instead of paying the much higher interest rates that the car dealership is offering you. In this way, you no longer need a bank to loan you money. You're using your own money as collateral to get a cheap loan from the insurance company. And all of this stuff sounds pretty great, at least on the surface. So wait, you're telling me that I can never lose money, that my money will grow and compound tax-free, and I'll receive dividends, and I never need to worry about paying high interest rates to a bank because I'm just going to use my own money as collateral to secure low interest rate loans? Yeah, sign me up. But there's a problem. So let's cut through the crap and see what's really going on. First off, fees. Any insurance product is obviously going to have fees associated with it. With term life insurance, the cheap kind where you only get the death benefit, you don't really pay too much in fees on a yearly basis, but you keep paying those small fees every month. month after month after month for your entire life. So when it's all said and done, you end up paying a lot of fees. Now, whole life insurance is a little bit different. With most policies, you pay nearly all of the fees within the first year or two. With these policies, of that $5,000 payment that you made to the policy, maybe $1,000 of that would cover your death benefit. $2,000 of it went to your savings aspect, and the other $2,000 was eaten up by fees paid largely to the salesman who sold you the insurance policy. The following year, most of your fees will be paid, and so the cash benefit aspect of your policy will start to increase a little faster and faster because less of the money is needing to go towards these fees. Now, of course, they don't tell you that it increases faster because you've already paid a crap load of fees the first year and got them out the way. Instead, they simply tell you that your policy becomes more efficient in later years. They use creative language to polish the turd that they just sold you. Now, in the long run, term policies generally cost you more in fees because you're paying a small amount, but you're paying that each and every year, potentially for many decades. So in the long run, whole life insurance policies will probably cost you a little less in fees, but those fees are pretty hefty initially and take time to recoup. It takes, on average, about 7 years of your policy being active and compounding interest to get out of the negative from paying these fees, and basically back to where you started at. So in 7 years, you're basically back to square one, while if you had instead invested that money into the stock market, it's fairly likely that your money would have since doubled by growing and compounding over those 7 years. Next up, let's look at those rates of returns. Now, these are guaranteed rates of returns, and usually it's about 3 to 4% growth rate and about a 1 to 3% dividend. So maybe 5 to 6% total between the two. So now we need to ask ourselves, is 5 or 6% growth rate good or bad? And the answer is, compared to putting it in the bank, earning 0.01% interest, it's phenomenal. But compared to other investment opportunities, it's not so great. The stock market, on average, returns roughly 10% annually for the last century or so. Now, yes, with your whole life insurance policy, it is 100% guaranteed growth, and there's nothing guaranteed about the stock market. Some years the market is doing great, other years it sucks, but once you combine all those years, the good, the bad, and the ugly, you end up with a roughly 10% growth rate in the long run. Now, the reason that insurance companies can guarantee you your growth is because they're in it for the long haul. You could theoretically take out an insurance policy and have a heart attack and die the very next day, and the insurance company would lose hundreds of thousands or millions of dollars paying out those benefits to your spouse. Just like a casino in Vegas can theoretically lose money on any particular hand of blackjack, but the casino and the insurance company know that if they repeat this process enough times, they're going to make money because the math is always stacked in their favor. So the insurance company is willing to take a possible short-term loss if the market dips in order to play the long game and make a ton of money at the end. How much money are we talking about? Well, let's assume that you paid into your whole life insurance policy for 50 years before you died, and let's just say that the cash benefit aspect of your insurance is being added to at a rate of about $2,000 per year. Now, at the end of those 50 years, at a 5% rate of return, the cash value of our account would have grown to roughly $418,000 at the end of those 50 years. Not too bad, right? Wrong. Now let's take a different scenario, and let's just say that instead of putting it into this insurance policy, we instead put it into the stock market and got an average of 10% yearly. Now, like I said, some years the stock market will go up, some years it will go down, but in the long run, it's historically averaged 10%. So at a 10% rate of return, our money would have instead grown to over $2.3 million. So at the end of those 50 years, that's almost a $1.9 million difference between investing at 10% versus investing at 5%. And who is basically getting that $1.9 million? Well, it's the insurance company. That's why they're in this for the long haul, and that's why they're able to guarantee you that lower rate of return. Now that we've kind of described the whole life policy itself, let's get into the concept of infinite banking itself and becoming the bank so you can loan money to yourself. First off, why are we supposed to be impressed with the concept of being our own bank and using our cash benefit as collateral to obtain a cheap interest rate loan? It's kind of like paying some other company interest just so we can access our own money. If instead of giving our hard-earned money to the insurance company, we had just put it in some other type of investment like stocks or bonds, we would still have access to our money whenever we wanted. So if we did have a large bill come due, we could simply access our money and be done with it. Why on earth would we want to loan ourselves the money and pay interest in the process? Just don't pay any interest. Just take what is rightfully yours and be done with it. Let's take a quick look at what some of the gurus are saying about this method.
Now, this one's mine. Listen, check this out. If you're earning 4% as an example in your insurance policy, and then you can access the money and, for example, put it into a real estate deal, like I was just showing you, these are actual real life hot deals that I'm in the process of buying right now. Let's just say theoretically that I'm earning 25%. I showed you deals where I'm earning 28%, 35%. If I'm earning 25%, and then I take that cash flow and I put it back in my policy, then my policy grows. I continue velocitizing it. It's actually paying for the policy. This right here, when I finally understood this, I had to get this set up for myself.
Now this guy has over 700,000 subscribers and he's gloating about how he took a cheap interest rate loan from his insurance policy to buy a real estate to earn a large return on his money via real estate. And it's true that your money continues to earn interest while you have a loan. In his case, he was earning 4% interest. But that's because you're not withdrawing the money. You're taking a loan and using your cash value as collateral. But he's probably paying 8% interest on that loan. So he's paying 8% and earning 4%. So net total, he's paying about 4% interest to access his own money. And that's great that he made a bunch of money in real estate, but he didn't need this insurance policy in order to invest in real estate. Now, it's true that the cash value from his real estate is probably able to cover the payments on the loan and build back that cash value. But there's no difference between that and using real estate cash flow to replenish your bank account or to replenish your stock portfolio if you had depleted either of those in order to fund the real estate deal in the first place. Now let's look at another video from someone with roughly 100,000 subscribers.
What you do with the policy, you take the policy and then you use the loan to invest in real estate to earn interest. You use the loan to invest in the stock market so that you can earn interest in the stock market. You use
Bitcoin, gold, silver, all of that.
Whatever it is, there's opportunities for us to make money by using our life insurance policy.
They say pretty much the exact same thing. They advocate using the cash value in your insurance policy to obtain a loan and then use that loan to go out and invest in real estate. Why? Look, guys, if you had $30,000 right now in your pocket, you could use that money as the down payment on a house and you could go and invest in real estate right now. Instead, what all these people are advocating for is that you should use that $30,000 to fund a whole life insurance policy and give that money to the insurance company. And then once the insurance company has it, you're going to turn around and ask that insurance company for a $30,000 loan so that you can use that money to go buy real estate. In what world does that make any sense? So you're giving the insurance company some money and then turning around and asking them for a loan for the exact same amount of money that you just gave them, and now you're getting charged interest on it. It absolutely blows my mind that anyone can think that this is a good idea. Now, don't get me wrong, there's nothing necessarily wrong with whole life insurance. For some people, being able to get a guaranteed rate of return is nice. And for these people, being able to take out a loan against your cash value in cases of emergency is a great option. But that's just it, for emergencies. But this notion that we should build up a cash value so that we can immediately turn around and get a loan against it so we can use the money to invest, that's pure trash. If you want to invest in real estate, then invest in real estate. But under no scenario should you ever invest in real estate by first funding a whole life insurance policy. The title of this video was How to Use Whole Life Insurance to Get Rich. The real title of the video should have been Invest in Real Estate and Get Rich, because that I would completely agree with. But the idea that insurance policy is somehow helping you to get rich just isn't accurate. There are people out there like my mom who are super risk adverse. They don't want any possible way to lose money, so they're more than happy to accept a relatively low rate of return from a whole life policy as long as it's guaranteed. I mean, she currently owns numerous bonds that pay less than 1% yearly interest. So if an insurance policy would give her 5 or 6% guaranteed, that would be a great thing. Now, obviously, the death benefits are a beneficial aspect of any life insurance policy, but some people will point out that many wealthy individuals take out very large life insurance policies against themselves, like Walt Disney himself. And then they make the argument that if the rich are doing it, then it must be a good thing, and use that argument to justify this infinite banking concept. But remember that just because somebody did something doesn't necessarily mean it was the most efficient way to do it. But more importantly, wealthy people play by a different set of rules. What is financially good for them may not necessarily be good for you. At some point, rich people aren't necessarily trying to become richer. Sometimes they just want to preserve what they have. And in that case, a guaranteed 5 or 6% interest is pretty fantastic. In addition, they already have more money than they need. They're worried about their future generations when they die. But when they do die, U.S. death tax kicks in and is going to tax your estate. The federal government is going to tax and take up to 40% of their life savings, not to mention what the state might take. Which means your children could lose half of your life savings or more to taxes when you die. But the insurance payouts from these insurance policies don't count towards this value and are generally exempt from the death tax. So for these ridiculously wealthy people, a large insurance policy could potentially save their heirs many millions of dollars in taxes when they pass away. For this reason, it's pretty common actually for wealthy people to have absolutely enormous life insurance policies. So for them, a life insurance policy like this might make some sense, but for the average Joe, In the end, there is a time and place for insurance and whole life insurance policies, but if you think that having a whole life insurance policy and infinite banking is some magic strategy that is going to revolutionize your finances because you saw some random YouTuber talk about it, then prepare to be disappointed. Because all you're really doing is paying interest to have access to your own money. If you enjoyed this video, consider subscribing for more straight talk about all things money related. Be sure to give the video a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.